Okay, perfect. People will be logging in throughout the presentation, but I think we can kickstart. Today we have our third session of the London Financial Regulations Seminar this year, and I'm very pleased that we have Paul Oudin, who is joining us today to talk about basically the case that has been occupying us lawyers over the last month or month and a half, the GameStop saga. And he'll be using that as sort of a pretext to discuss the issues we see with market manipulation, both in Europe and in the US. Very happy to have Paul here. He's a French attorney, and he's currently in Oxford doing research on market abuse and in particular on insider trading regulation. So today he'll be talking about GameStop, and I'm very keen to hear his thoughts on the specific case and what the sort of legal implications, the wider legal implications are. So Paul, I'll give the word to you. Perhaps as a sort of housekeeping rules, feel free to interrupt Paul during the presentation if you have any sort of technical issue or anything's unclear. We'll have a more extensive debate after the presentation, but do feel free to ask any questions you might have to Paul while the presentation is ongoing. Okay, Paul, on to you.
Thank you very much, Catherine, for this introduction. And as Catherine said, feel free to interrupt me at any point if you wish to have more explanation, especially on the first part where there are a few microeconomic concepts that might be slightly tricky and for which you might want a bit more explanation. So really don't hesitate to interrupt me at any point. Okay, so okay, let me check. Oh yeah, right. So before we delve into the subject matter of today's presentation, maybe a few words about the GameStop case, although I guess every one of you already heard of it. So GameStop is a US company. It's a video game retailer listed on the New York Stock Exchange, which has enjoyed a considerable surge in its stock price as of mid-August 2020. And as a consequence, many investors, and especially professional short sellers, so short seller being someone who bets against the stock price of the company, decided to take considerable short positions on the shares of GameStop, betting that obviously the share price of GameStop would collapse subsequently. And although short sellers are in many respects very useful for financial markets, especially because they allow to identify overvalued or fraudulent companies, and I'm especially referring here to active and activist short sellers who actively seek to obtain information about these companies and publish reports, many people don't like them at all, and so the general public at large tends not to especially appreciate short sellers. Many issuers, obviously, when their stocks are shorted, don't like them either, and many institutional investors don't either. So, so this is the reason why, among others, a few so-called gurus, so few sophisticated investors, called on retail investors and institutional investors on Reddit forums to massively buy shares of GameStop in order to push the price of GameStop up, thereby forcing short sellers to close their positions or hedge them at considerable losses. And there are many very interesting legal issues surrounding this case. Two of them are the suspension by Robinhood, which was a broker through which these retail investors invested, Robinhood's suspension of trading in GameStop shares. There is also the question of payment for order flow with Citadel. So these are two very interesting questions, but that we won't cover here today because we won't have time to cover them. And so rather this presentation will focus on another very interesting topic, hopefully, which is the one of market manipulation rules. And before talking about the legal stuff, we will have to cover a few economic aspects of manipulation, which are, in my opinion, crucially important to understand why we are forbidding market manipulation. And the most fundamental reason why market manipulation is prohibited all over the world is because of its microeconomic impact that we are going to talk about in a minute. And another reason, but which is generally more implicit, less well assumed by the text, is that this microeconomic impact of manipulation can have macroeconomic or even systemic consequences for financial markets. So let's start with the microeconomic impact of manipulation. So to understand this impact, we need to understand the big picture of how the order book of a security works. So essentially, the order book of a share consists in a collection of limit orders. And the limit order to trade is an order to trade in a security when it reaches a certain price. And the people who post these limit orders on the order book of issuers are called market makers. And so, for instance, when a market maker posts an order, a buy limit order of 30 on the order book, this order will execute as soon as a market order, a so-called sell market order, will arrive. So an order that will execute at whatever best price is available will arrive on the market. So if you are a market maker, you post a buy limit order of 30, and your limit order happens to be the most favorable buy limit order on the market, you are the next order that will trade against a sell market order. A sell market order being, once again, an order that will trade at whatever best price is available on the market. So now let's think about the situation, such as in GameStop, where the market orders arrive massively on the market in the same direction. Let's say, by taking this example, this picture you have here, that 50 buy market orders arrive in the market. If you look at, on this picture, you look at the ask side of the order book, so the side of the sell limit orders, you see that there are approximately 50 orders, 50 sell limit orders between a price of 35 and the price of 45. And so what is going to happen is that these 50 buy market orders are going to execute against these 50 sell limit orders, and the new best sell limit order available will be an order at 45. And this is how, among other things, the price of the security increases when buy limit orders arrive on the market. But there are other factors. Now, suppose that you are a market maker and you're here with all your limit orders outstanding, and you see all these guys, these retail investors, these institutional investors, posting their buy market orders on the market, and you start to thinking, wait, okay, so there is considerable interest in the security. And I'm here with maybe, I don't know, 30 or 40 limit orders at 45, and I know that my orders are the next one against which market orders will execute. But you start thinking, well, if all these people are willing to buy the security, it's very possible that many of these orders could execute at a much higher price. Maybe all these people arriving on the market at the same time are willing to pay a very, very high price for this security. So one of the reactions you're going to have is that you're going to withdraw these 30, 40 limit orders that are around the price of 45, and you're going to redistribute them on a much larger price range. For instance, by putting 10 orders at 45, 10 at 55, 10 at 65, etc., in order to account for the fact that many people who are currently posting market orders may be willing to pay a much higher price for the security. And what this means is that at any given price range, there will be less limit orders available because precisely of this phenomenon of withdrawal and redistribution of orders on the order book, which means in turn that for the same number of market orders arriving on the market and executing against sell limit orders, the price increase would be much greater, because now instead of executing against 30 orders at 45, the market orders will execute at 10 at 45, 10 at 55, 10 at 65, and the new best limit order available will be maybe 65 or maybe much higher. And as you see that you're available as a market maker to sell securities for a much higher price, you're obviously willing to buy them at a much higher price. So pretty much the same thing will happen on the bid side of the order book. This collection of buy limit orders, these orders to buy securities at a given predetermined price. So on the buy side or the bid side of the order book, the price is also going to increase. But the difference with the ask side is that it will increase less than the price on the ask side. And the reason is that although you're not willing to sell your securities for a much higher price because you see all these market orders arriving on the market, you won't be willing to buy securities with that big an increase in the price. And the reason is that you have absolutely no clue about what the price of the security is going to be in an hour, in a day, or even in 10 minutes. So although you will distribute your sell limit orders on a greater price range, you won't buy securities at too high a price because you can fear that the price is going to collapse subsequently and that you're going to lose everything. And so this means that there will be three joint effects of this movement of massive buy market orders. The first is obviously a considerable increase in the share price as people buy shares and market makers readjust the order book as a consequence. Then because the bid price is going to increase less than the ask price, the difference between the best buy limit order and the best sell limit order will be wider. This is what we call the bid-ask spread. And what this means is that all the people that may have been willing to trade at a price between 600 and 900 in this example won't be able to do so because there is essentially nobody to trade with them. And so this is a problem for liquidity because there are many orders that could be economically useful, that could be efficient, that won't occur because of this considerable bid-ask spread. So this represents three effects at the same time: a considerable increase in the price of the security. So the price being pretty much, so this is a rough approximation, but you can consider it at an average of the bid and ask prices, an increase in the price of the security, considerably a larger bid-ask spread, which means less liquidity, and also the order book on both sides will be less deep, meaning that there will be less limit orders per tranche of prices, which means that the prices are going to be more volatile. So this means that in this new situation, this new normal, the price is going to fluctuate widely. It's going to be very difficult to trade between these two extremes of the bid and the ask side. And the prices won't reflect the reality of the company anymore because precisely the price push is not linked to any fundamental consideration. And so this is a problem for market efficiency. Market efficiency being defined as a market where prices reflect the fundamental value of securities. It is obviously a theoretical idea, but we want markets to reflect as much as possible the fundamental value of the issuers, the underlying issuers, and we want also the capital to circulate easily. And the reason why we want both of these things is that we want that capital, so the money, be allocated with best use. And if, for instance, you have an issuer that is overvalued, what this means is that this issuer will be able to raise more money than is justified by its economic reality. And likewise, if an issuer is undervalued, it won't be able to raise as much money as it could, as it should be able to do because its economic projects are sound and that you could deserve this money. And the problem with lack of liquidity is that there are many transactions where this capital should be allotted that won't be able to happen, precisely because the bid-ask spread is extremely large or because the volatility is extreme, and as a consequence, you won't be able to buy all the securities you would have been willing to buy at any given price. So, and what happened in GameStop was, so as I said, a considerable increase in price, less liquidity, more volatility, and so I'm not, sorry, just a precision, I won't discuss now whether what happened in the US was a manipulation or not. But what we will see for now is that what happened in GameStop was exactly what we fear can happen when there is a manipulative behavior. This considerable increase in price that is not justified by the fundamental value and these liquidity problems. So for now, all we can say is that this is what we don't like in market manipulation, and this is what I described just before that happened in GameStop. All right, so this microeconomic effect is the fundamental reason why we don't want market manipulation in the first place. And this is how market manipulation is traditionally discussed. And a very simple reason why is that this functioning of the financial market, this interplay between price and liquidity, what we call the market microstructure, is common to pretty much any financial market in the world. Obviously, there are some markets that are more efficient, there are some markets where prices are more accurate, there are some markets that are more liquid than others. But essentially, price and liquidity are behave pretty much in the way that I just described. But then we have also the macroeconomic potential impact of this microstructure effect. And the macroeconomic impact is very different depending on the economic circumstances surrounding the manipulation. So to take the example of GameStop, we've seen that this considerable surge in price led to a lot of short sellers being squeezed out, a lot of short sellers incurring tremendous losses. And the effect of this kind of phenomena is that it discourages short sellers from exercising their activity. And what I'm saying right now is not theoretical. It actually happened with one very famous short sellers, which is called Citron Research. And this activist short seller has just decided to completely stop its short selling activities after what happened with GameStop by realizing how risky it was to be a short seller. So these guys just said, okay, we're out of it. Being a long investor is much less risky, and so we will just completely change our activities. So these things happen. Now, the macroeconomic effect of manipulation, as I said, is very context dependent. If, for instance, we imagine a world where short sellers are everywhere, you don't really mind if a few of them are squeezed from time to time. But the world in which we live is a world where there are very few short sellers left. And so obviously, discouraging these guys from exercising their activity can have a disproportionate impact on financial markets at large. Because if you don't have short sellers on the market, it's very simple. You have essentially nobody that is incentivized to identify fraudulent and overvalued companies. I mean, you have the regulator, but we've seen with the DPhil how efficient and how competent regulators are sometimes. And this is all you are left with. You are left with the DPhil and long investors, which is a fantastic world to live in. But more seriously, what it involves is that if there are no more short sellers, this discount that should impact the stock price of of fraudulent or overvalued companies will be spread out on all shares of all issuers on the market, which means that there will be more volatility because of more uncertainty as to the stock price, what the stock price will be next, and there will be asset price bubbles. And for another caricatural asset price bubble, you can see Wirecard typically. And this macroeconomic effect can itself be considerably amplified by other factors. And one of these factors in today's world is what we call passive investment. So what a passive investor does is, rather than inquiring into the fundamental soundness of an issuer, we will track an index which is composed of a number of securities, and will seek to replicate this index as well as possible. So for instance, let's say that you're BlackRock or whatever other passive investor, and you want to track the S&P 500 index. So this index representing the 500 biggest listed companies in the US. What you will do is that you will buy shares of all of the components of this index, depending on their relative weight in the index. And if, for instance, the weight in the index is conditioned by the stock price of a given component, each time the price of the stock will rise, we will buy more of this stock, and you will sell other components of the index. And you're not the only guy doing that out there. So what is going to happen is that each time a given component rises, all these passive investors buy this component on the index, so the price rises again, etc., etc. And if you mix all these effects, so this microstructure effect with the fear of short sellers of being squeezed, plus this amplifier effect of passive investment, you can see that market manipulation, which seemingly had only an impact on a given issuer, can in fact have a considerable impact on the market at large. And so this is quite a scary chart, in my opinion, but maybe you would be less sensitive than me. But essentially what this chart says is what I just said about passive investment and volatility. So let me just explain it quickly. So what you see on the y-axis here is the index of the co-movement of securities. And what this means is that at the co-movement of 0, 50% of the securities of the S&P 500 index are moving up, and 50% are moving down. So there is essentially no co-movement on a daily basis between the securities, whereas when the co-movement is at 500, it means that all the securities move up or down together on any given day. And between these two extremes, there is this chart, which represents the co-movement since 1928. So just a quick technical precision: the co-movement is an approximation of the correlation, but it's computationally much easier to calculate. And there is pretty much no data before 1990 about correlation. So this is why co-movement is used for longer periods in time. And what we see here is that the co-movement started to the co-movement itself is obviously very volatile, as we can see on this chart. But what we can see is a general tendency of increasing since 1996 or 2000, and around 2020, so March 2020, we see that the co-movement was approximately of 250, which means that during this period, 75% of the securities composing the S&P 500 index were moving together on a daily basis. So this means that this extreme correlation effect, co-movement effect, exists today. And although it's extremely difficult to compute the exact impact of a given manipulation on the market at large, on the macroeconomic conditions of the market, we see that there are amplifier effects out there that should be taken into consideration when we wonder whether a given behavior should be prosecuted or not. And now let's do a bit of law. So we've seen the economic impact of Gamestop, the economic impact of manipulation at large, and now we need to wonder whether Gamestop can be considered as manipulation. First of all, we need to notice that although there are different definitions of manipulation in both the EU and the US, are framed in very broad terms. These are very broad definitions and abstract, and this is a necessity because nobody really knows what a manipulation is really. We know what their effect can be. This is what I just described. We know that there are some behaviors that are intuitively wrong, but we struggle a lot to have an abstract and general definition of what should be a manipulation and what shouldn't. And here are two illustrations. So first of all, I've mixed two definitions of market manipulations that you can find in the market abuse regulation in Europe. So yeah, sorry, the Article 12 of the market abuse regulation is the article concerned with market abuse, market manipulation in Europe. Yeah, there's just the Article 15 that deals with the sanction, but the definitions are in this article. And I've just taken two of these here. So you see that pretty much everything can be considered as a manipulation in Europe. It suffices to enter into a transaction or to disseminate information that makes the price deviate from the fundamental value of the issuer to be a manipulator. That's essentially what this text says. And obviously, national market authorities are not going to sanction everyone each time there is such a deviation. But what it means is that this text can be interpreted in a very, very broad manner. Whereas in the US, as you can see, so I've put here a small citation from the Article 985 of the Securities Exchange Act of 1934, which is the basis in the US for the prohibition of market manipulation. And for instance, for manipulation that translates into the circulation or dissemination of information, you see that not only you see that in addition to what you would be required in the EU, you need the first consideration. So you need to have benefited somehow from this manipulation, and also you need to have intended to raise or depress the price of a security through this circulation or dissemination of information. So obviously there are some conducts that will be sanctioned in the EU, but not in the US, at least theoretically. Then obviously market authorities are free to interpret the text in different ways. So now to answer this question of whether Gamestop-related events could be considered as manipulation. So it's kind of speculative at the moment because we don't have all the facts about this case, and the SEC has launched an investigation. So we will need to know more about what happened exactly to have any definitive answer, obviously. But in a first approximation, we can see that yes, in the EU, if these events happen in the EU, text would be adequate to sanction them on the ground of market manipulation. Once again, this will depend on how national authorities eventually decide to interpret the text, but the text is there and it can be interpreted in this way. In the US, so yeah, just to illustrate it, let's take the example of a sophisticated investor that tells to the market, okay, guys, let's buy massively securities so that we can short squeeze short sellers. This behavior will have the impact on the price that is artificial. It will push the price of the security at an artificial level. And although you could consider that this guy was perfectly legitimate in saying that, and this is true, I mean, it's true. If these guys were going to massively buy shares in GameStop, the short sellers would be squeezed out, and effectively the price would keep rising. But it doesn't matter for the EU. It's the mere fact that the price is pushed at an artificial level is sufficient to command their application. Same thing for retail investors. You can take all these retail investors who didn't have a clue about what they were doing and who just wanted to reap a small profit, didn't have any idea that it was forbidden, potentially forbidden behavior, didn't have any idea, any clue about what would be the impact of this on short sellers. These guys as well could be considered as manipulators for the exact same reason, for the reason that their trades contributed to push the price at an artificial level. In the US, it's different precisely because, first of all, you need consideration. So if for instance, our so-called guru who invited all these retail investors to buy securities just did it without investing himself in the security, or in case it was very difficult to prove that he received any benefit from it, this guy couldn't be sanctioned for manipulation. And same thing in case, for instance, he actually wasn't sophisticated at all and just happened to be there and happened to hate short sellers and to love GameStop and just said something without really thinking what he was saying. So the conclusion is that EU rules allow at least theoretically to sanction pretty much anything and not US rules. Now, what are we supposed to do with that? And here, I don't know if there are any US lawyers here. I'm not a US lawyer, so I'm just giving my interpretation of a pretentious European lawyer explaining code. No, I'm just kidding. But so I'm just going to give my interpretation of the rules as I read them, and I think that these rules, unfortunately, don't allow to prosecute a number of conducts that should be prohibited on the ground of market manipulation. Typically, what happened in the US, and for the reasons described before, can have dramatic consequences both from a microeconomic and macroeconomic perspective. And what I believe is that when someone can foresee reasonably that their behavior will have this kind of very detrimental externalities on financial markets, they should be incentivized to avoid committing this kind of acts. And so probably US rules to avoid a certain number of behaviors that are very detrimental for financial markets should be amended. In the EU, it's most probably not necessary because of what I just said. So the texts are already so large that it's probably not necessary. But what would be useful would be for the European Securities and Market Authority, the ESMA, to issue guidelines explaining to national market authorities how they should interpret the text, because although they benefit from this very large text, national market authorities are not willing to interpret it in whatever direction, and so ESMA guidelines would be useful to orient them. And in any case, so this is just what I said before, I think that this idea that you should sanction only someone who intends to be a manipulator and who does a very well-defined manipulation is somewhat artificial and doesn't really fit the world in which we live. Because today it's very easy to have completely disproportionate impact on financial markets without bearing the consequences of this act. This is where, so once again, I'm not judging what did people in the specific Gamestop case, but what Gamestop allowed us to see is that some people can just go out there and start telling their mind on Reddit forums and then have an extreme impact on the securities prices. And I don't think that the question of whether these guys received consideration or intended the effects or not do really matter, in fact, because what really matters is to disincentivize these behaviors that have absolutely no economic rationality and can have all the detrimental impacts I exposed before. And this is to take another example, because it's not just about the GameStop, but let's talk about algorithmic trading. If you have an algorithm that enters into manipulation in circumstances where the person developing this algorithm didn't foresee at all this manipulation and didn't plan for it, isn't that still a problem? I mean, you would want this person to avoid ex ante that their algorithm enters into manipulation, and so I think it might make sense. So then there would be a debate about the threshold where you should put the liability. But it makes sense to incentivize ex ante people to be careful when they deal with financial markets, at least to a certain extent. So where are we now? So on February the 18th, there were hearings of the US Committee on Financial Services. And these hearings were mostly concerned with everything but market manipulation, unfortunately. So they discussed a bit about market manipulation, but the discussions were mainly focused on two other very, very interesting and tremendously important topics, which were trading suspension by Robinhood and the payment for order flow. But in the EU, there were hearings on the 23rd of February, where in addition to a few other topics, market manipulation was discussed. And with a think tank of which I'm part, which is called Droit et Croissance, we've been interacting with a few representatives of the European Parliament. And we've been very pleased to see that an MP of the European Parliament, Luis Garicano, has pushed forward one of the ideas we were promoting, which is the issuance of ESMA guidelines in view of dealing with this specific question of market manipulation. So hopefully something will happen on this front. And that's it for my presentation. So if you have questions or want to discuss anything else, please go ahead.
Thanks a lot, Paul, for the very interesting presentation. I've really enjoyed the sort of macroeconomic perspective on that and the consequences of it. So thanks a lot for that. I know there's already a question, but from Professor Rosa Lastra, but feel free to either post your question in the chat or raise your hand, and I'll allow you to speak. So I think Rosa, you wanted to take the first question.
Yes. Let me first thank you very much, Paul, because this was a really interesting and insightful presentation on GameStop, and also the comparison between the US and the EU when it comes to market manipulation. I was particularly delighted that you mentioned at the end the proposal by Luis Garicano, since I have worked a lot with Luis Garicano. We have written papers in the past, and is someone that in issues of accountability of the European Central Bank, since he is at the European Parliament, I work with him on a regular basis. So very, very delighted that you mentioned him. But my question relates to the broader picture. and not so much to the issues that were discussed in the US congressional hearings, but how the whole incident raises issues of change in market structure and efficiency, also issues of democratization of stock markets, and then finally effects of ultra-loose monetary policy. So I don't know if you want to talk about any of these broader issue pictures before we get into some of the questions on the more specific aspects that you so ably discussed today.
So yeah, thank you very much for these questions. Actually, these are points that I would have liked to raise directly in my presentation, but due to time, I had to make a few choices. So for retail investors first, I think that indeed there are many consequences of market manipulation rules toward them. So a point of view that I have defended with Javier Paz-Valbuena, who is here with us today. We've written together a small piece about GameStop on the Oxford Business Law blog. And the idea is that market manipulation should be geared, should be geared toward people triggering mass movements rather than people participating in this movement. And so what I believe is that if we had to have an evolution of existing market manipulation rules toward anything, it should be toward the sanction of people having a disproportionate impact on the markets rather than people contributing to movements. So to this extent, I think that market manipulation rules, if they should evolve, shouldn't concern a lot of retail investors. They shouldn't be the target of these rules. And something else is that I don't think that be it the existing rules or possibly future rules can discourage retail investors because they are usually not, I think, in the scope of these rules. They are politically doesn't really make sense for a market authority to prosecute someone who just made €100 by buying an overvalued share. So this my broad perspective on it, and maybe I'm wrong, but I don't think that market manipulation rules are a very big deal for retail investors, and I don't think that, especially that they could dissuade them from investing, which is something we wouldn't want to have. And regarding very loose monetary policy, I think that this is one of the factors that have fueled all this. Actually, I should have mentioned this in my macroeconomic description of the things, because effectively the fact that you can raise debt at an extremely low level and take an extremely levered position involves systematically that share prices are more volatile. It involves failures of companies that go much quicker, and so this concerns not only investors who are going to buy securities on margin, but it also concerns issuers which are financially not sound but will nevertheless manage to raise tremendous amounts of debt and thereby increasing considerably the bubbles on their stock price. So I think I think that the very loose monetary policies of the ECB and even in the US have an amplifier effect, considerable amplifier effect of market manipulation practices. Does it answer
very much? Thank you.
Yeah.
And then on the, I don't know if you want to say further on this idea that now everyone, particularly given the effects of the pandemic, and that everyone can become an investor with a computer home, and the kind of almost like sociological changes in stock market behavior, which can also lead to a decrease in transparency, because part of what the stock market does is provide, of course, transparency to investors. I don't know if, I don't want to take too much of your time, but I think the issue is fascinating in itself, but also fascinating by the broader implications of what it reflects.
No, I completely agree. That's a fantastic question, and I fear I don't have any very good answer to give. And the way I see things is that we tend to think because there hasn't ever been. Retail investors don't occupy that big a place in financial markets. The direct investment is just is a minority. We've seen with GameStop that it could change things in certain respects, but we don't see it as a main actor of financial markets. And we tend to see a dichotomy between passive and active investors, with a few professional investors that are actively seeking to invest in specific securities, and passive investors, which are these big BlackRock, etc., that just invest in indexes. And in the middle, there is this category of retail investors that honestly I don't really know what role they play in financial markets, because for most of them they are actively inquiring about securities. On the other hand, so it's a bit pretentious to say that, but you could also say that they don't have the same knowledge as active professional investors, so they don't always know what they're doing. They might also be more prone to so-called irrational coordination. So it's a very interesting question, and I think regulators should keep thinking about it and what is their place in this ecosystem.
Thank you very much. I think, Katrien, there are other questions.
Yeah, there's a few questions in the chat. One is from Sanya, who is asking about whether there's a fine line between freedom of speech and market manipulation. I guess that relates a little bit also to the fact, maybe I can add on a related question that I have, is to what extent should we regulate this in the field of market abuse and market manipulation, or should we just regulate social media and social media platforms and sort of limit a little bit what information could be disclosed there, could be shared there? Should we have financial platforms where these things are being discussed? I think that relates a little bit to Sanya's question. But basically, is this part of market manipulation rules? Is this not a different set of rules that we should use to regulate this type of behavior? Yeah,
absolutely. Thank you very much for these questions. So to start with this question of freedom of speech, yes, there is obviously a trade-off to make between market manipulation and freedom of speech. So obviously, so what I would say is that when you speak, this is the broader overview, but when you speak online about financial instruments, once again, you're taking a decision, you're doing something that will have consequences for you, but will especially have the completely disproportionate consequences for the rest of the market. And be it because of freedom of speech or just because we live in a free society where people should be able to express their opinion about financial securities, this is expressing oneself about the security shouldn't be a problem and shouldn't be prosecuted. But I think, and this is very difficult to find the right threshold, but I think that at some point, if you express yourself and this expression doesn't have any other effect than making a security completely overvalued and vice versa, there should be some form of regulation dissuading you from the most egregious forms of statement. And I'm sorry not to be able to propose an exact standard myself, but I think that should be a beginning of reflection around that. And at the very least, put a very low standard, just saying, for instance, that when it's completely obvious that your behavior is extremely damageable without any rational interest behind it, you should be forbidden from entering in it. And then there is this question indeed of whether we should regulate specifically social networks, or we should be concerned with market manipulation rules at large. And so this is very interesting. I mean, there are many reasons why we could be regulating social networks. I think they just go much beyond this question of market manipulation, and I'm absolutely not a specialist of this area of the law. But yeah, I mean, it could make sense, for instance, to force the platforms such as Reddit or Facebook to date the same thing as what they already do for terrorism or that kind of publications, force them to actively investigate this kind of behavior and prohibit them ex ante. This is possible. Honestly, I've not thought much about it, so this is merely an opinion, I'm afraid. But yeah, there is this possibility, and then there is also the possibility for prohibiting a number of things aside of market manipulation rules. When you think about short squeezes, for instance, short squeezes are a practice that in many cases are just obviously abusive but are never prosecuted. And you could think that indeed short squeezes themselves should be subject to a separate regulation. And really, what this presentation was doing was more using Gamestop as an excuse to rethink about this entire market manipulation system. And I think that what is interesting in using general rules such as those of market manipulation rather than forbidding specific behaviors is that it allows you to preempt a number of other behaviors that can be extremely problematic, but are nevertheless not directly dealt with by more specific rules. And so this is what I think would be the main benefit of the evolution I propose, which is anticipating very, very damageable behavior and influencing ex ante the behavior of financial agents.
Okay, perhaps I can have a tag-along question there. Do you think retail investors will actually be influenced if they're not aware of the fact that they're actually impacted by market manipulation rules? I can imagine that people on the platforms not necessarily were aware that they might actually be subjected to it ex ante, and therefore it wouldn't impact their behavior, and that would not be the effect that you want from the intervention.
So do you mean that retail investors would risk fearing to be sanctioned by market manipulation, and thereby would be dissuaded from investing?
Yes, I mean, would they be able to, or would they? So if you want to ex ante discourage this type of behavior, they should be aware of the fact that they're actually engaging in market manipulation.
Well, you not. I mean, I'm not suggesting that we should sanction retail investors when they participate in GameStop-like movements. I would rather say that. I mean, the sanction mechanism that I would advocate for consists more in sanctioning those that have the biggest impact on the leaders of movements, such as these sophisticated investors who post messages on Reddit forums. It's also these algo traders that I was mentioning. I'm absolutely not talking about these retail investors who are just an accident of this movement. So, I mean, I don't think there is a risk that the retail investors themselves be dissuaded from trading.
Okay, understood. And there's a few more questions. I think we can group two together that relate to sort of short selling. From Sophie Vermeer, who asks, how do you explain that US securities can be shorted above 100% threshold, whereas we never see such situations in the EU? And then we have another question related to short selling by Manas. Can GameStop scenario happen in other jurisdictions like the UK or Europe or the European Union? And then should there be some threshold in taking a short position in a stock?
Okay. Three very interesting questions. For the first one, the answer will be rather quick. I don't know. All that I know is that short sellers is much more widespread in the US, and these are positions that are much more easy to constitute in the US than the EU, which is why you can see a much higher short interest on any given security than the EU. Then I think that the question was why we could have a naked interest. We can have a short interest of more than 100% on some securities, while naked shorts are forbidden. And so I thought a bit about this question, and honestly, I've not found an exact answer yet. I would tend to think that this is for reasons due to the fact that there is a settlement delivery delay between. So maybe short sellers, short selling naked short rules could be circumvented, for instance, by shorting. By having as a counterparty someone at a T and someone else at T+1 during the settlement period. I'm not really sure about the exact reason why, so I prefer not to answer anything stupid. And the next question was about the possibility of this phenomena happening in Europe. Definitely not the same. Definitely not. So the first reason is that retail investors in Europe absolutely don't have the same financial culture as in the US. They would never invest so massively in the mid-cap security. It's not even a big Facebook or Google. It's just, I mean, GameStop is a mid-cap, and it's usually very difficult to invest in when you're a retail investor because there are just no broker to allow you to do that. Also, rules regarding investment of non-professionals in the EU are more stringent than in the US. So it would be legally very difficult. And I don't even mention the possibility of buying massively called options on securities such as what happened in the US. So a call option is essentially, so it's an option to buy shares at a certain price, which is called a strike price. And this is a kind of instrument that are basically absolutely not accessible to EU investors. So obviously, I'm absolutely not trying to, with this presentation, I'm not trying to anticipate that the same kind of movement will happen in Europe and that we need all these rules to anticipate that. Once again, it's just an inspiration from this case for broader market manipulation rules. But yeah, so I would say definitely not. But then there can be other phenomena similar to this one that could happen in the future. And the next one was about the disclosure thresholds and short selling, right? So okay, so okay, and so how was the question framed again? Was it do disclosure threshold favor or disfavor?
Should there be some threshold in taking a short position?
And my answer, it depends on what you're talking about. Are you talking about threshold of disclosure to the company or to the regulator? To the regulator, I don't see any reason why this disclosure shouldn't happen, because I mean, you're just sending information to the regulator, which is then able to take action upon this information. So only you just assume that your regulator is completely incompetent. You're supposed to think that this is a good thing. Then disclosure to the company is a completely different question, because when essentially, why would you allow companies to know that there is a given short interest in their shares? You do that because you want them to answer to that. And how do they answer to that? So first of all, why do people short a company? A reason is that maybe that they simply seek to hedge an exposure against a long position in this company, against a long position in other companies, in which case the companies don't have a really good reason to be worried about that. Or they can be active investors, which actively think that this company is overvalued or hiding something or fraud or committing fraud. And in which case, the disclosure allows the company to answer to that. But I mean, as long as the short seller hasn't disclosed any report or hasn't voiced an opinion on the company, we don't really see why the company should anticipate that, for instance, 0.2 or 0.5% of its capital is shorted. And it can even have a very detrimental impact, which is that, let's say, once again, that you're a short seller. So as I explained before, we want short sellers to exercise their activity because we want them to spot overvalued companies. And we also know that this short selling activity is very risky. So what we want is that when short sellers are right, or at least when they think they're right, they're not disincentivized to exercise their activity. And a good way to incentivize them to exercise this activity is to allow them to constitute a substantial short position before, for instance, they disclose a report or their point of view about a given issuer. And to allow them to constitute a short position at not too high a cost, we need to avoid, we need to avoid that their position be disclosed too soon in the constitution of this position. And I don't think that the interest of the issuer in knowing that a short seller has a given interest in its security justifies the cost that it represents for a short seller to have its position disclosed at very low level, such as those we see in the US and the EU.
Okay, Grant, thanks a lot. We have a hand raised by Lixvi. Perhaps, Lixvi, do you want to raise your question? Open your microphone and raise your question.
I was just wondering if is it just a one case, or is it possible that it can happen again in the future? So are there direct measures that Gamestop case won't happen, and if so, are there already strategy from short sellers to do they already plan anything to counter such market manipulation?
Thank you very much for your question. So whether this event can happen again, obviously, I don't know for sure, because this is the kind of stuff that is very hard to anticipate. What is clear is that today the social networks, as shown by Gamestop, allow for people to voice an opinion much more easily than ever before. And know that Gamestop is a precedent. In my opinion, and this is just what it is, an opinion, there is a good chance that this kind of events happen again in the future. Then whether short sellers have a strategy to counter this kind of event, once again, I don't know. I think that you can hardly predict that kind of stuff. And I don't think that the strategies of short sellers would be fundamentally impacted by this. But all that I can say, and this gets back to what I said before, is that the mere possibility that this kind of event can occur is very dissuasive for short sellers to exercise their activity. And this is what we saw with Citron Research just completely stopping their short selling activities.
There's another question by Benjamin Schmutz. Might these events be more frequent in the future, or is this only one idiosyncratic due to the pandemic, physical constraints, available savings from some, etc.?
Well, essentially, I answer the same way as my answer to Felix. Maybe just adding that there were clearly many favorable circumstances for this event during the pandemic. There were these $600 checks by the government to the public at large, which was used by many as a lotto ticket. If I may say, to gamble on financial markets by many retail investors. So yeah, obviously there were circumstances favorable to this event. Then once again, I absolutely don't know whether this kind of specific kind of event will happen again in the future, although there is reason to think that it will be more likely than before.
We have another question by Alessandro Vecchio. And he's basically asking whether in market manipulation we should consider this as sort of herding behavior, and whether there might be sort of a way of basically having an anonymous group to be considered as engaging in market manipulation, and whether that be something that could be useful.
I mean, useful for what? So for
basically a useful mechanism. I think he doesn't specify it, and I see he's not online again.
Okay.
But I guess the question is whether the concept of a herd being able to move markets, whether we should we basically take that into account when we're regulating markets, because obviously there's no identifiable person who could be liable, although one person wouldn't be able to impact the market prices, but a herd would. And so what do you do with that when you're looking into market manipulation regulation?
So I would say that, I mean, the recommendations I would make consist precisely in identifying the leader of the herd. And so this guy that will completely say something and provoke this disproportionate effect. So I think only this guy should be the subject to the attention of the regulator. And it's not only for theoretical reasons, it's also because you can't prosecute tens of thousands of retail investors that make micro investments. It's just absurd. And beyond the fact that it's technically impossible, I think that politically it would be a very, very bad idea. So yeah, I think that's my answer.
I have one. I think Rosa has one more question. I have one more question.
Yes. I find this so exciting that before we close the session, I have one more question, and that relates again, talking a little bit about the broader picture. And I'm glad that you mentioned the economic benefits of short selling, because I think that sometimes on this side of the Atlantic, we look at short selling as if that was almost like a sin, an original sin of some of the practices of hedge funds and hedge fund managers, when in fact, it helps in many ways, both in price discovery as well as to clean up from, zombie enterprises. So it has an important function, and I think that sometimes underservingly on this side of the Atlantic, it has a very bad reputation. But my question kind of is broader than that. It is on some of the practices of hedge funds, particularly some of the most aggressive hedge funds, that maybe use this short selling technique in a way that is not really conducive to the real price discovery function or to the real function of efficiency of financial markets, but rather purely speculative. And that is sometimes the ones that deserves the bad reputation that this short selling, which is, a very valid market technique. And so do you think this will also have repercussions? There's always, with hedge funds that, the need for more regulation, more transparency. So do you think that this will lead to a further re-regulation of the hedge fund industry, or somehow will be diluted within just general market manipulation and some other reforms in the securities field?
Well, I don't think that, I don't expect short sellers to be subject to harsher regulation in the near future. And what I can say is that I completely agree with you. There are some very damageable practices by short sellers. For instance, I've worked on cases of PIPEs, so private investments in public equity, where essentially what they do is that they buy shares, they subscribe to convertible bonds by issuers, and also share subscription warrants. And what they do is that, so there is an anti-dilution clause in these indenture agreements. And what happens is that if the issuer's share price falls, they convert their bonds and then they dilute the issuer, which means that essentially if the issuer goes well, so these are usually distressed issuer with great financial difficulties. If the issuer goes well, they would just get reimbursed for their bond. And if the issuer doesn't go so well, they convert their bonds and they take the control of the issuer. So they benefit from this control premium and they restructure them thereafter. And some of the short sellers, pipe investors, what they do is just before they convert their bonds, they take massive short positions on the issuer. And obviously, when you convert your bonds and you take control of the issuer, it makes the share price collapse. And so the short position is extremely lucrative for them. And in addition, it further depresses the stock price. allowing them to convert their bonds at even better conditions. So these kind of practices exist, and yes, arguably in many respects, they are not a good thing for market efficiency. But then these are specific practices, and I think you can just find the equivalence in long positions as well. And what I think, so from a prospective perspective, I don't think that short sellers at large should be sanctioned for these few specific cases. And once again, as to what the U.S. legislator will, how the U.S. legislator will react to the recent events, honestly, I don't know. But I don't expect them to further sanction short sellers for this reason.
Perhaps I'll have a tag along there. But do you think that there's actually a true danger, like you were sort of discussing in the beginning of your presentation, that we'll lose the positive side of short sellers because less of them will engage in the market? Because I would always think that if there are less people around, there'll be market push there'll be more opportunities for people who do re-enter the market. So I would think there's some economic equilibrium there, where if it's really true that everybody withdraws from the market, re-entering the market would actually be very fruitful, and there's a lot more low-hanging fruit. So I'm wondering whether that's something we truly should be worried about or not.
Well, this idea, yeah, that's a very interesting question, a very interesting aspect of it all. This question of this equilibrium between investors and the lucrative character of the strategies, whether new investors enter because others exit because of the strategy not doing so well anymore, has been notably studied with the distinction between active and passive management. And so I've not delved into this literature in a very great depth, but from what I understand is that it's very difficult actually to do any sort of calculation of any of this sort of calculation, and many of the equilibriums that we've observed in the 10 last years, for instance, with passive investors having an increasing place in the financial ecosystem at large, is very difficult to justify by any theoretical model. This is the impression I have. So I wouldn't tend to think, obviously when you're crowding out a few market players, then it leaves more room for others to enter. Then I don't know where to strike exactly the balance between this dissuasive effect of GameStop-related events and the opportunity that short sellers have to enter in the market. But what I can see is that there are very, very few short sellers left on the markets today, and a few of them are still exiting. You see Citron Research, which was a great short seller, which was exited, just makes me think that we're more pushing toward less short sellers than more. And in addition to that, one needs not to forget that the short selling in itself is a super risky strategy, because as long as the financial markets will keep growing, as long as there will be economic growth in the world, companies will have growth, and as long as we do not enter into stationary or even a declining growth, short selling will be an intrinsically risky and losing strategy. In addition to that, you bear a number of costs when you're borrowing and reselling shares to an institutional investor, because this institutional investor who will lend you shares is going to charge you a premium for that. And so there are many reasons why being a short seller is inherently difficult. So I wouldn't expect any favorable equilibrium to short sellers to create itself anytime soon, if that makes sense.
Great, it makes sense. We're 7 o'clock, unfortunately. So thanks so much, Paul, for this really, really engaging presentation and discussion. I think it shows that there's lots to be discussed on this matter, and it raises a lot of interesting topics, which you very, very clearly brought to us. So thank you very much. So let's all virtually use our emoji to thank Paul. We'll have another session in a few weeks where we'll discuss mega banks and how we should, whether we should break them up or not. So thank you very much, Paul.
Thank you, and thanks for the invite and the great questions. Very interesting.
Thank you. And thanks everybody for joining. Hope to see you all in the next session.